Good evening from New York. It's 6:32 p.m. on Wednesday, March 25th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are now closed for the session, and there is a lot to unpack tonight. Let's get right into it.
Good evening. Let me frame the tape. The S&P 500 closed at 6,592, up 0.55%. The Nasdaq gained 0.77% to 21,930. The Dow rose 0.66% to 46,430. Small caps outperformed. The Russell 2000 jumped 1.23% to 2536. But here's the tension. The VIX remains elevated at 25.35. The 10-year Treasury yield is sitting at 4.33%, and the 2-year is at 3.62, giving us a positive yield curve spread of 71 basis points. The market regime right now is what I'd call a bifurcated grind. Equities drifting higher on ceasefire speculation and AI momentum. But under the surface, you've got 186 advancers against 325 decliners in the S&P. Breadth is weak. The real story is a three-way collision: the Iran war's inflationary impulse, a potential diplomatic off-ramp, and the AI investment cycle powering through the noise.
Let's start with the war. Iran's foreign minister came out today saying Tehran has no intention to hold direct talks with the U.S., but they are reviewing Trump's 15-point peace plan. Meanwhile, the White House scheduled a Trump-Xi summit in Beijing for May 14th and 15th, which the press secretary explicitly linked to an expected 4 to 6 week war timeline. How should investors read these conflicting signals?
You have to separate the diplomatic theater from the supply chain reality. Iran rejecting a ceasefire while simultaneously reviewing the peace plan via mediators, that's classic posturing in the early stages of back-channel negotiations. The key tell is Iran's counteroffer demanding control of the Strait of Hormuz, which is obviously a non-starter, but it means they're engaging on terms. More concrete is the Trump-Xi summit being pushed to mid-May. The administration is telling you implicitly that they expect the kinetic phase to wind down by then. But here's what matters for markets right now. Oil prices have jumped more than 40% since February 28th, according to CNBC. Gasoline is at $3.98 a gallon, up more than 30%. Diesel has soared over 40% to $5.37. The USPS is seeking an 8% fuel surcharge on packages. The EPA today waived summer gasoline regulations to allow broader ethanol blending. These are real economy inflation impulses that are already baked in, regardless of what happens at the negotiating table over the next 3 weeks.
That diesel number is striking, $5.37 a gallon. That doesn't just hit consumers at the pump.
Exactly. Diesel is the transmission mechanism for goods inflation across the entire supply chain. Trucks, freight trains, farm equipment, it all runs on diesel. That 40% spike feeds directly into transportation surcharges, which flow to food prices, which hit restaurant margins, which erode consumer discretionary spending. KB Home already lowered its full-year guidance this week, citing the Middle East conflict. Zillow's chief economist modeled out housing scenarios, showing that if mortgage rates stay 50 basis points above their pre-war path and unemployment rises even 20 basis points for the rest of 2026, existing home sales would actually decline 0.73% year over year. Before the war, 30-year mortgage rates were at 5.99%. They're now at 6.5%. Mortgage purchase applications dropped 5% in just 1 week. So the causal chain runs like this. Iran war disrupts oil supply. Oil spikes 40%, diesel hits $5.37, transportation costs surge across the economy, the 10-year pushes to 4.33 on inflation expectations, mortgage rates jump 50 basis points to 6.5, housing demand stalls, and home builders like KB Home cut guidance. That's 5 steps from geopolitics to a real family deciding not to buy a house.
And that yield move, what does this mean for the Fed? Before the war, there was still talk of rate cuts in the second half of 2026. Is that narrative dead?
It's not dead, but it's on life support. The 2-year at 3.62 tells you the market still prices the Fed funds rate coming down eventually, but the 10-year at 4.33, 71 basis points higher, tells you term premium is being repriced for inflation persistence. What was a rate cut narrative 2 months ago is now shifting toward a prolonged hold, with the risk tilting towards tightening if energy-driven inflation bleeds into core readings. The Fed is trapped. They see the same diesel and gasoline data we do. If headline CPI prints north of 4% in the April or May readings because of energy pass-through, the Fed cannot cut. And if the war extends beyond the administration's 4 to 6 week estimate, you could see break-even inflation expectations force the Fed to at least signal hawkishness, even if they don't hike. The base case is on hold through September. The risk case is they're forced to hike by year-end.
Let me shift to the cross-asset picture. You mentioned oil and yields. How are bonds, gold, and the dollar behaving relative to each other? And does anything look anomalous?
The cross-asset picture is internally consistent, which actually gives me some confidence the market is pricing rationally. Oil up 40% is pushing yields higher through inflation expectations. The 10-year at 4.33 reflects that. The dollar is strengthening on a relative growth and rates basis because the U.S. is an energy producer while Europe and Asia are net importers. Gold is catching a bid from both the geopolitical risk premium and the $100 million in Venezuelan gold the U.S. just physically repatriated, which Interior Secretary Burgum confirmed today at CERAWeek. Energy stocks, 100% of the sector is above both its 50-day and 200-day moving averages, with over 90% near 52-week highs. Meanwhile, real estate is the mirror image, only 16% above the 50-day, 45% near 52-week lows. That's the yield sensitivity showing up in asset prices. Bonds and equities are both under pressure from the same force, energy-driven inflation expectations, which is why the VIX is elevated at 25 even on a green tape. Traditional correlations are holding. This is a classic supply shock playbook.
Now, there's also a significant tech story today. ARM Holdings, ticker ARM, jumped 16% on its new AGI chip announcement. How does that fit into this macro picture?
ARM's announcement is structurally significant for the AI investment cycle. They revealed their first in-house chip designed for AI inference in data centers, projecting $15 billion in revenue from that chip alone by 2031, with total revenue of $25 billion and earnings per share of $9. Citi called it the most significant shift in the company's history. Meta is the first customer. This connects directly to Meta's $135 billion AI capex plan for this year. The chip sector rallied broadly. Advanced Micro Devices, ticker AMD, gained 4.17%. Super Microcomputer, ticker SMCI, jumped 6.41%. NVIDIA, ticker NVDA, rose 0.89%. What this tells you is that even in a supply shock, geopolitically stressed environment, the AI infrastructure build-out remains the structural growth engine that institutional capital will not abandon. It's a parallel narrative that runs alongside the war, and today's session proved that when you give the market a concrete AI catalyst, it responds even with the VIX above 25. So who are the clear winners and losers from today?
Let me break it down by time horizon. Cyclical winners, energy producers, particularly exploration and production names. EQT was up 3.71% today, and the entire energy sector is trading near highs. They benefit directly from elevated oil and gas prices. Basic materials, especially fertilizer names like Mosaic, ticker MOS, up 4.22%. Higher energy costs lift commodity input prices, and the ethanol waiver increases corn demand. Auto parts retailers like O'Reilly, ticker ORLY, up 3.22%. When consumers can't afford new cars, they repair old ones. Structural winners, AI semiconductor infrastructure, ARM, AMD, and the broader data center supply chain. Meta's $135 billion in capex, regardless of the war, creates a multi-year demand floor. Utilities, 74% above their 50-day, 84% above their 200-day, benefit from both the AI power demand narrative and defensive rotation. Space and defense stocks, Rocket Lab and Firefly Aerospace surged 10 to 16% on reports of SpaceX filing for an IPO seeking a $1.75 trillion valuation. The defense buildout is structural regardless of war duration. Cyclical losers, airlines, United, ticker UAL, dropped 3.47%. They're getting hit by both the jet fuel spike and the DHS shutdown, with over 11% of TSA officers calling out and 450 having quit. Home builders, KB Home cutting guidance is the canary. Mortgage rates at 6.5%, with purchase applications falling 5% week over week. Financial services, only 4% of the sector is above its 50-day moving average. Higher for longer rates compress net interest margin expectations as credit quality deteriorates. The New York Fed flagged rising delinquencies today. Structural losers, rate-sensitive consumer discretionary, only 11% of the sector above its 50-day, nearly 19% near lows. Higher fuel costs erode disposable income, and if rates stay elevated, big-ticket purchases get deferred. Social media platforms face a new structural headwind. Meta was hit with $375 million in damages in New Mexico, another $6 million verdict in the LA addiction trial today, and they're cutting several hundred more jobs. These legal liabilities are becoming a recurring expense line, not a one-time event.
I want to flag something there. You named Meta as both a structural winner through AI infrastructure and a structural loser through legal liability. How do investors reconcile that?
Great catch, and the answer is business segment decomposition. Meta's AI and advertising engine remains among the best in the world, 3.58 billion daily users, Instagram Reels watch time up 30% year over year, 135 billion in planned AI capex. That's the winner, but the platform liability exposure is a separate and growing drag on the equity. The stock is down nearly 9% over the past month and trading well below both its 50-day and 200-day moving averages. The market is telling you it can't fully price the legal tail risk. So the net positioning call on Meta is, the AI story is real, but the regulatory and litigation overhang means you need a wider margin of safety to own it. It's not a conviction long at $5.95. It's a name you watch for a washout entry below $5.50, where the legal risk is more fully discounted.
What's the risk case investors should stress test against right now?
Let me give you both scenarios. Base case, diplomatic back channels produce a framework by mid to late April, consistent with the administration's 4 to 6 week timeline. Oil retraces 15 to 20% from current levels as Strait of Hormuz risk diminishes. The 10-year yield drifts back toward 4.1%. The S&P grinds towards 6,800 by the end of the second quarter, led by energy, AI infrastructure, and a relief bid in beaten-down consumer names. The Fed holds rates through September, then begins signaling a December cut if inflation moderates. Risk case: Iran's 5-point counteroffer stalls negotiations, and the war extends through the summer. Oil pushes above $130 a barrel. Diesel hits $7 a gallon. Headline CPI prints above 4.5% in May. The 10-year yield breaks through 4.75%. Mortgage rates spike above 7%. In that scenario, housing activity contracts outright. Zillow's model shows a negative 0.73% year-over-year decline, even under milder assumptions. The S&P corrects 10 to 12% from current levels to the 5,900 range, with consumer discretionary and real estate leading downside. The Fed is forced to hike 25 basis points by September, and the yield curve reinverts. That's the scenario that turns a manageable supply shock into a policy-induced recession risk.
Given those scenarios, how should investors be positioned?
Highest conviction, energy producers. Immediately increase exposure over the next 2 to 4 weeks. The risk-reward is asymmetric. If the war ends quickly, energy stocks give back some gains, but remain supported by global demand recovery. If the war extends, they are the primary beneficiary.
Names like Diamondback Energy and ConocoPhillips are trading with strong momentum. Both gained 2 to 3% even yesterday when the broader market was flat. Secondary conviction, AI infrastructure. Maintain exposure structurally. ARM's AI announcement today validates that AI capex is a multi-year cycle. NVDA, AMD, and data center server plays like Dell up 3.56% today, and Hewlett-Packard Enterprise up 5.74% are the picks. Tactical hedge, short-duration treasury exposure. With the 2-year at 3.62 and rate cuts deferred, the front end offers reasonable carry with limited duration risk. This is your portfolio shock absorber. Avoid rate-sensitive consumer discretionary and home builders. The combination of 6.5% mortgage rates, falling purchase applications, rising contract cancellations, and builders cutting guidance creates a multi-quarter headwind. Real estate investment trusts, with 45% of the sector near 52-week lows, should be underweight until the 10-year yield has a sustained move back below 4.1%. When it steps back, this is really about a single question. How long does the energy supply shock persist, and can the AI investment cycle offset the drag on the broader economy? The Iran war has injected a 40% oil spike into a consumer that was already showing signs of K-shaped stress. The New York Fed's delinquency data confirms that. Yields at 4.33 reflect the market pricing in sticky inflation, but not yet a recession. Meanwhile, ARM's chip announcement and Meta's $135 billion capex plan remind you that the structural AI build-out continues regardless of geopolitics. The diplomatic signals, back-channel messaging, Trump-Xi summit in May, EPA fuel waivers suggest the administration is managing for a shorter conflict. But the market is rightly demanding a risk premium, which is why the VIX is 25, even on a day the S&P gained 0.5%. Breadth at 186 to 325 tells you this rally is narrow and leadership-driven, not a broad-based risk-on event.
Give us your 3 takeaways for tonight.
1. The risk. If Iran negotiations stall and the war extends past May, the inflation impulse from diesel at 5.37 and gasoline at 3.98 becomes embedded in core prices, forcing the Fed's hand and threatening a policy-induced recession. 2. The market insight. Today's session showed that the AI investment cycle is powerful enough to generate a positive equity day, even with oil up 40% and a VIX above 25. That's the structural floor under this market. 3. The positioning call. Energy producers are the highest conviction trade in the near term. AI infrastructure is the structural hold, and anything rate-sensitive, home builders, REITs, consumer discretionary, should be underweight until the 10-year yield gives a clear signal below 4.1%.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.